right. Hello, everyone. Welcome in. We have a great presentation for you today. I just want to let everybody properly connect to the presentation before we get started. Hope everybody's having a good day. I see people funneling in now. Going to give people another minute or so. I know it's 12 o'clock now, but we'll probably get started around 12:01, 12:02 when I see the registrants slow down filing in, excuse me. I appreciate all your patience. Just another minute or so. All right. Actually, I think that should be good. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and would like to thank you all for joining us for today's webinar, Litigation Finance, the Lucrative Recession-Proof Asset Class of the Future, with Andy Zook, Ken Bonenberger, and Michael Shaw. As a quick note, please be aware that we'll be answering questions. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone you know who believe can benefit from the information, have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'm more than happy to help. And without further ado, I'll pass the controls over to you guys.
Excellent. Will, thank you. I'm Andrew Zook with Experity Ventures. I'm responsible for investor relations at our elite group of companies who specializes in providing non-recourse pre-settlement cash advances to plaintiffs in personal injury lawsuits. Litigation finance is a lucrative, recession-proof, and fast-growing asset class. Today, I'm joined by several members of the Experity's executive management team who are going to give you a look under the hood of our finely tuned machine. We're going to shed light on company financials, share our rigorous underwriting criteria, and detail our tremendous growth. Before I turn the webinar over to our Chief Financial Officer, Michael Shaw, and our Chief Risk Officer and General Counsel, Ken Bonenberger, I want to feature several achievements that Experity has accomplished in recent years. First, speaking of that executive management team of ours, they have over 55 years of experience in our very unique industry. With their direction, our team of 55 full-time employees have grown company assets from $10 million just 6 years ago to well over $400 million today. We are well on our way to executing our vision to become a billion-dollar company. Experity's business model is one that on average, we advance $1 to a plaintiff in a personal injury lawsuit. We receive back $1.50 in 18 months or less with historical loss rates of under 1.9% of advanced capital. So we enjoy very impressive margins in a business that is virtually recession-proof. Experity has been recognized on the Inc. 5000 fastest growing private companies in America list 3 successive years. We achieved high rankings on that list in 2021, 2022, and 2023. If any of you are familiar with the Inc. 5000 list, it's a difficult list for a private company to claw its way onto. If you're more familiar with the criteria for inclusion, the rolling 3-year growth requirement makes it very unusual and extremely difficult to make that list 3 successive years. So that is an achievement that we here at Experity are quite proud of. I'm going to share my screen. All right. As Will mentioned, the recording, Camaplan will record today's webinar and make it available to you. Should you not be able to stay on for the duration of today's presentation, but you would like to speak with someone further about our investment opportunities to diversify your portfolio, I want you to know that this is slide 1 and 11 in your presentation. You can scan this QR code on that slide. It will take you directly to my calendar where you can reserve some time with me and I can answer any questions that you have on our investment offerings, the litigation finance asset class at large, or on our company. The phone number that you see on your screen will connect you directly to my cell phone. So you can contact me there by phone or text and speak with me directly, or you can email me here. With that, our Chief Financial Officer, Michael Shaw, is going to share much more with you. I will hand it over to Mike.
Thank you, Andy, and good afternoon, everybody. My name is Michael Shaw. I'm the Chief Financial Officer of Experity Ventures. I've been with the company since 2018, and approximately 7 years. Prior to joining Experity, I was the Chief Financial Officer. I was the Chief Accounting Officer for the J.G. Wentworth Company. Prior to that, I was a Vice President with Santander Bank. I started my career with Ernst & Young as an auditor. I'm both a CPA and an attorney, and I have more than 9 years experience in specialty finance. I'm going to pass on to my partner and general counsel, Ken Bonenberger.
Thanks, Mike. And good afternoon, everyone. Thanks for coming. I've been in the space for 15 years, been with Experity since 2016. Prior to that, I was also, like Mike, with J.G. Wentworth and Peachtree Financial, and ran the underwriting for those companies for their pre-settlement funding departments. And prior to that, I was working for a couple of banks as an in-house counsel. So yeah, that's me in a nutshell. So here, this first slide just gives you a little high-level overview of what the litigation finance industry looks like currently. And this is within the United States market size per year. On average per year, their funding is about $1 billion in funding is being given to plaintiffs, and that is growing at an estimated 20% annually. Similarly, the medical receivable side of this, which is very similar to plaintiff funding, it's all personal injury related. That accounts for $4.6 billion in medical advances, and that's growing at an even higher rate at 25%. And just to show you what the total personal injury market looks like, there's $160 billion in claims settled every year. So just goes to show you there's still a lot of room for growth within the industry. Here's a good slide that shows you how your average personal injury case plays out chronologically from left to right, and how a funding company comes into play with the plaintiff and the providers that treat the plaintiffs, and also the attorney that represents the plaintiff. On the first week, an injury, somebody gets in a motor vehicle accident, somebody has a trip and fall at a store, something along those lines. Usually what happens in that time frame, they either immediately after the incident, they either go to the ER, taken by EMTs to the hospital, they go to urgent care, they go to their primary healthcare physician just to get their initial treatment and list what their initial injuries are. Then they get an attorney. The attorney begins to work up the case. They gather documents, police reports, incident reports, photos, whatever it may be. And during that first 3 months of the case, the client is also receiving treatment for their injuries that they sustained as a result of the incident. Usually it begins as conservative care, chiropractic treatment, physical therapy, things of that nature to get an understanding of what's going on with the injuries. And usually during that time frame also the defendant's insurance carrier is put on notice of the claim. And then about 4 to 8 months, if the conservative care doesn't alleviate the injuries, that's when more intensive treatment begins. They'll get more advanced diagnostic studies, MRIs, EMGs, To a certain degree, they'll start getting pain management like epidural steroid injections. And during that time, at that point, the medical providers that are treating them, most of the plaintiffs don't have their own insurance or they're underinsured, whatever it may be. And so they issue what's called a letter of protection to the doctors that are treating them, which is essentially a commitment on their part. Hey, I can't pay you now, but when my case settles, I will pay you for the treatment that you're providing to me. And the doctors aren't in the business of waiting 18 months, 2 years, whatever it takes for the case to settle. They want to be paid now. Enter the funding company. What we do is we pay them a percentage of whatever their gross bills are, and we acquire the rights to be paid at the end of the case. That way, the doctors get paid now, and we will ultimately recover the money we paid them. Plus, as Andy said at the initial call, usually a buck for every dollar we fund, we'll get back $1.50, $1.60. And then, during that time frame, also the plaintiff is frequently out of work or they're underemployed because of their injuries. They need funding to get them through to help them pay bills, to help them pay rent, whatever it may be. So we'll also offer the plaintiff some funding at that point in time as well. Typically, we're talking, the treatment, because the treatment is still pretty early on, we'll fund anywhere between $500 and $3,000 during that first 4 to 8 months. Now, the next step, the months 9 to 16, the conservative treatment still hasn't alleviated the injuries. More intensive treatments needed. This is where usually surgeries will start to take place, whether it's a shoulder or knee arthroscopy, or a discectomy, or even a fusion to their neck or back. At this time, what those treatments do, they primarily, most importantly, they help the plaintiff treat their injuries and get back on the way to health, but it also increases the value of the case. Now they're expending more money to get the treatment. We then step in again, and we'll buy the letters of protection from the doctors. Typically, in this instance, we paid $7,500 for an LOP. Similarly, the plaintiff now, because they're having surgery, they're even more incapable of returning to work. So we, at that point, will give them an additional $7,000 in funding. And then you get to the 17 and 24 months of the case. The case is still ongoing. Treatment has been concluded. They don't need any more surgeries or treatment, but they still need a couple extra bucks to get them through to the settlement. Again, we'll give them another $1,500. Generally speaking, within 24 to 30 months, the case either settles or goes to trial. In this case, at the far right, we have, just for the purposes of example, we have a $100,000 settlement. At that time, when the attorney gets that money, it goes into his trust account. The attorney takes his fee and his costs off the top, and then pays the medical, or he pays the funding company who acquired the letters of protection and who gave the funding to the client. And at the bottom of that finish line section, you see we had advanced $10,000 to the plaintiff, and then we collected $15,000. Similarly, on the medical side, for the letters of protection we acquired, we paid $10,000 for those letters of protection, and we collected $15,000. So total of that $100,000 settlement, we're collecting $30,000 of it. I think.
My bad. Hang on a second. Get the screen up here.
Gotcha.
Sorry, Ken.
That's all right.
Share. Let me get us off of here. Sorry for the technical difficulty. Let's go here. There we go. The next slide.
Sure, please.
Okay. Can you see the screen, Ken?
I cannot.
Okay, I apologize. Let me get out of that. Let's try this again. All right, share screen. How about now? Can you see my screen?
I cannot.
Okay. 1 second. Share options. Yeah. Here we go.
There you go.
Have you got it now? Excellent. Thanks for your patience, friends. There we go, Ken.
Sure. So this gives you an overview of the pre-settlement advance portion of the funding, which goes to the plaintiffs. You know, as we mentioned previously, the claimants, the people who were injured in the accident, they sometimes need funds to pay medical bills, pay rent, other essentials, while their attorney is litigating the case for them. So they don't have to take a lowball offer from the insurance company. Um, Again, they don't have access to traditional sources of funds. They can't get a bank loan, for instance, or maybe their savings is insufficient to carry them through. So that's where we come in to help them out with those cash needs. Essentially, our investment method, we have a team of underwriters. They go through each case in great detail, thorough analysis of the documents that we get directly from the attorney. We go through police reports. We go through incident reports. We go through medical records. We find out who the insurance carrier is and what the policy limits are. We also do extensive background searches on the plaintiff themselves, make sure that they don't have some background that would affect our lien come settlement time. They don't have an open bankruptcy, for instance. There isn't a child support lien. There isn't a state or federal tax lien. They don't have any untoward criminal history that could be used to impeach them at trial. So we run all that through, all the underwriters go through that in great detail, and we come up with a case value based upon that. And once we derive that case value, which generally is conservative, it's more conservative than what the attorney usually values it at. And then once we have that value, we can fund up to 10 to 15% of that value. So say, for instance, we have determined that the case has a value of $100,000. We can fund the plaintiff up to $10,000 to $15,000. Now, what that does for us is that we're valuing the case conservatively to begin with. And then secondly, we're curtailing how much we can fund to the plaintiff. That way, when the case settles, let's say it does settle for the $100,000, say we funded 10,000, we get back 15,000. There's still a lot of room there, even if our estimates are off in terms of our case value. There's still a lot of room there to make sure that we get back our 15,000, or our principal deployed plus our accretion, for the total of the $15,000. And then the investment structure and the flow of the funds at the bottom here. We have a standard contract. It's acknowledged, the contract is between us and the plaintiff, but we also have the attorney acknowledge that there's documents, pages within the contract where the attorney acknowledges our lien and effectively says, yes, I understand you gave my client money. When the case settles, I'll make sure to touch base with you, get your payoff letter, and make sure you get paid. The key there is the attorneys have ethical obligations to safeguard the property of third parties, i.e. the funding company, which is, which gives those contracts a lot of teeth. Yeah, and again, we're looking, the insurance carriers, another one of the key criteria is we have to have an insurance carrier in place, and we have to know the policy limits. That way we know that we know that there's funds there to settle any injury lawsuit. Yeah, this just goes into a little bit of our underwriting process. We have as I mentioned, we come up with case values. We have a very advanced algorithm and case value calculator that goes into that. We'd like to say that the underwriting process is part science, part art. The calculator, the algorithm, that's the science part of it. We also have, as I mentioned, attorney analytics and background checks That's some of the art to it, figuring out, okay, is this a good attorney? Do they have a proven track record? Is this somebody who, we know that more likely than not they're going to get a good result for that client. And again, the background checks, we do deep dives and make sure we're dealing with both the plaintiff and attorney that we want to do business with. And this goes in, on the right-hand side, it gives you a little bit of information about our loss rates. We've settled principal amounts of $406 million. We have a cumulative losses of 11.2 million, but that's cumulative loss of only 2.75% of our principal. So the underwriting team is spot on. They know what they're doing, and we get good results. Yeah, this is just a little bit of the company snapshot. We have both pre-settlement funding and a medical funding business. As I mentioned, we have offices in primary offices in Conshohocken, Pennsylvania, and we also have an office down in Boca Raton, Florida. We have a sales team of 13 professionals who are out there pounding the pavement, developing relationships with attorneys, going to conferences, working with brokers to make sure we get good quality leads in. And we also have a group of JV partners, smaller companies, smaller funders in the space who didn't have access to the capital that we do. We white label everything for them, meaning everything, outward appearance, everything is their logo. It's on their paper, but we handle everything from soup to nuts. We were the ones sending out the money, and most importantly, we're the ones collecting the money when the case settles. We've worked with more than 2,000 attorneys and healthcare providers across the United States, and we currently have about 50 full-time employees. And now I'll turn it over to our CFO, Mike Shaw.
Thank you, Ken. The next slide is talking about our significant growth that we encountered over the last several years. As Andy mentioned, we were named in the Inc. 5000 3 years in a row. And you can see our growth over the last 3 or 4 years, and the trajectory will continue to over the next 2 or 3 years. We have a few other strategic opportunities that we are working on at this moment in time, and we expect to execute over the next quarter. And between now and the end of the year, we expect to acquire another company and increase our footprint. If you're looking at our EBITDA, very profitable company, both on a net income basis as well as the EBITDA. In 2024, our EBITDA was $66 million, and we expect 2025 to be at least $71 million, if not a little bit higher. And when you're looking at the amount funded, our trajectory here is just talking about our organic business, doing what we do day in and day out, that without taking into account any additional strategic opportunities. In order to support that growth, we have several dedicated, committed warehouse lines facilities at our disposal. We have one facility with East West Bank that currently is committed at $135 million. And we have another facility with Synovus Bank at $125 million. And we also have a rated revolving facility that the main investors, our insurance company, has been rated by KBRA. And that's currently maxed out at $100 million. And I'm in the process of setting up another revolving warehouse lines for $200 million. And your capital will go alongside those warehouse lines, since we're only getting a specific advance rate from those warehouse lines. Next slide, please.
This one good, Mike?
No, the next one, please. Yep, here you go. No,
Okay.
I think one back. There you go. So the next slide is talking about the single unit economics, and I think Ken mentioned that before. Cash on cash across the business, it's $1.50. So for every dollar we deploy, we get $1.50 back in about 18 months or less. But if you try to bifurcate it between the preset and the medical, you will see that our cash on cash on the pre-settlement is approximately 1.4, but the duration is a little bit shorter. It's approximately 14 to 15 months. On the medical receivable, cash on cash, we're getting $1.60. The duration is a little bit longer. It's around 18 to 19 months. But overall, both aspects of our business are extremely profitable on a blended rate, $1.50 in 18 months or less. And I think the next slide is yours, Andy.
Great. Folks, what you see here are a list of the investments that Experity Ventures has offered just since 2021. So not only do we have tremendous amount of experience as savvy operators in the litigation finance field, but we also have vast experience creating and offering lucrative income-focused investments for our clients. Two things of note on the slide here. The yield of our current offering, which I'm going to detail next, is the most lucrative out of any of these offerings that you've seen us have since 2021. And what you see at the bottom of the screen is extremely important. The reliability of our payment stream for our investors. All invested capital from these offerings has been fully redeemed to our investors along with all of their interest payments. So we offer a valuable diversifying investment with an income stream that isn't impacted. Lastly, let's talk about the current offering that we have. It is paying a 12% yield. We're distributing that interest quarterly. The minimum investment amount is $50,000. You can get involved with cash or IRA dollars. Obviously, if you want to use qualified money, you're going to use your CAMA account to fund the investment with us. An important thing to note about the 12% yield. With our offerings, once you subscribe, that interest rate is fixed for the duration of your investment. It does not change based on future Fed fund rate reductions. So when you're in, that remains fixed for the duration. Our current investment offering is a 5-year yield. Our clients love that. They can rely on this to diversify their portfolio and enjoy an exceptional yield for the next 5 years. I should point out that our investment is set up as a standard interval fund. So there are early withdrawal privileges that are available to our investors with some written caveats. Those withdrawal privileges kick in after year 1 in the investment, and they are detailed in writing on pages 8 and 9 of the private placement memorandum that any interested party would receive from us. I think I could say as a whole for our investors, they value the offerings that we provide because our business model is not impacted at all by inflation, by geopolitical events that may occur. Short-time economic things such as tariffs don't impact our business. Significant drawdowns in the major stock market indexes for the other side of your portfolio have literally no bearing on our investment. I should also note that Experity, we believe in full investor transparency. We want to help you in your due diligence process. So you will receive a private placement memorandum that clearly enumerates the risks involved in the investment and details all the various features of the investment and our company. We have clean audited financial statements from every year we've been in operation. And during your due diligence process, if you'd like to review those, you've got to execute an NDA with us, but we would be happy to provide those to you as well during your due diligence. Before I turn it back to Will, I'll mention one common question that I get. Mike went through our impressive capital stack. He mentioned that we have $360 million in dedicated senior lines of credit with $200 million more on the way to provide the liquidity that we need to grow our company. One of the questions that I get asked a lot is, why do we need your money? Well, we utilize your money because those senior credit facilities require us to have some skin in the game. Look at it this way. If you go to a bank and want to take out a mortgage, they require you to have a down payment. Our credit providers want us to do the same thing. They want us to put 10 cents in for every dollar that we advance to our plaintiffs. And we utilize the money from our subordinated note investors to satisfy that requirement from our senior lines of credit. Will, that concludes our remarks on the informational portion of our presentation. If if you want to moderate a Q&A, Ken and Mike and I will make sure we answer all questions.
Yeah, absolutely. Great presentation. Thanks for all of the information. And like Andy said, if you have any questions, please use the Q&A function and the chat function to post them, and I'll read them off to Andy, Ken, and Michael to answer. We do have one question that came in as you were wrapping up. Is this a 506B or a 506C?
Great question. This is a 506C. We have two investment offerings currently. In one of our operating entities, we have a 506C, and in another one, we have a 506B. Today, we're speaking clearly about the 506C with ThriveVest, which is for accredited investors only.
Perfect. Thanks for the answer. Thanks for the question. That was the only question at the moment. Let's see if anybody, I'm sure people are typing now. While we have Andy, Michael, and Ken all with us now and have their time, please don't be afraid to ask some questions. So a question you may have is probably something somebody else is thinking, so you're helping another person out as well. And you said with the investment, it's about a 5-year duration.
It's a 5-year duration. It's an interval fund. There's an early withdrawal privilege after 1 year, which I'd be happy to review with any interested parties about how that works.
Okay, perfect. Not seeing any more questions come in. Is there anything else that you would want people to know? Specifically, if we're getting close to wrapping up, one more time, a contact information, how people can reach you if anybody's watching the recording after the fact. I believe you had your QR code up, right?
Yep, right there. Can you see that, Will?
Yep, perfect. Thank you. And as I was saying that, another question just came in. Actually, 2 more came in. Perfect. There we go. Thank you, guys. Brian asks, are there specific types of litigation you will fund? Any requirements for certain states or insurance carriers?
Yeah, I can take that one. Yeah, this is all personal injury cases. So motor vehicle accidents, slip and falls, trip and falls, medical malpractice, people hurt on the job, things of that nature. And you know, in terms of requirements for the insurance carriers, there really aren't. You know, we just need to make sure that the defendant that's being sued by the plaintiff has insurance with a rated insurance company, and we need to know what those policy limits are. And in terms of the states, it is a very state-specific industry. There isn't any broad federal legislation, but it's the law within each individual state dictates whether or not you can do business in that state. And most of the states you can do business in. Not all 50, but most of them you can.
I want to add a couple of other points. For example, we stay away from mass torts. That's not something that we fund, and it's not something we're able to fund on our warehouse lines. It has complete different risk characteristic than a pre-settlement. Our portfolio is well diversified. We don't have any single concentration with significant concentration with any insurance carrier. All of our insurance carrier are A1 or better, and that's something that our warehouse lines look at.
Perfect, thanks. And this kind of plays into I believe what you were talking about. Just to post Jay's question to you, do you ever turn down the case because you are not comfortable with the insurance company?
Yes. Yeah, the answer to that is yes. There's certain carriers that are, as Mike said, below a specific rating. And there's certain ones that, have gone into receivership. For instance, in New York City, American Transit does a lot of insuring of the cabs and limos up there. And it's just had a troubled history. So if we see that American Transit is the insurance carrier, we're not going to fund that case.
Perfect. Thanks for the answer. Thanks for the question. We do have some more questions pouring in, which is great. I love to see it. Glenn asks, do you have to be an accredited investor?
So for the ThriveVest offering, you do. So securities law is very complex, and we adhere to every portion of it possible. So Experity does make a 506B offering available. We scrutinize the investor's portfolio and financial assets and investment objectives. Try to establish if there's, at least an initial relationship with someone. Have some conversations about your assets, your conversation. So if there are non-accredited investors that we encounter, there can be opportunities there if the company and our compliance department deems it's an appropriate investment for them. We don't want to put anyone out over their skis or put them in an investment that has a greater risk profile. Not that we feel ours is risky, but we care about all of our investors. We want to look after non-accredited investors, especially because they don't have as deep of a pile of assets as accredited.
Perfect. Thanks for delving into that for us. Thanks for the question, Glenn. Next question comes in from Kyle. He says, with the credit facility, does that mean each case is funded 90-10 in the event of a loss? Is it shared 90-10 as well?
No, so let me address that. So this investment is subordinated to the warehouse line. So our warehouse line is always in first position. We have some other facilities as well, but this investment itself is subordinated to the warehouse lines.
Perfect. Thank you for that, Michael. Thanks for the question, Kyle. Next question comes in from William. What is the geographic and lawyer diversity in your book? Are most loans through big firms or single practitioners?
I can handle that, Ken. Our biggest concentration would be in the main states of New York, Texas, Florida, Georgia, Pennsylvania, Chicago, and California. We don't have more than 30 to 35% concentration, obviously, in any given state. And as far as our law firms, yeah, we can have $5 to $10 million with a single law firm out of our $400+ million that we have deployed. That being said, those law firms will have anything from 200 to 300 partners. For example, Morgan & Morgan, Thomas Joe Henry, and a few other alike, who have hundreds of attorneys who is litigating thousands of personal injury claims.
Perfect. Thanks for that answer, Michael. Thanks for the question. Next question from Brian. How is the approximate 1.5x return calculated? Is that a guaranteed number locked into your advanced contracts, or does it vary over time, perhaps based on a rate?
It's a good question. So on the pre-settlement side, every contract has a specific implied rate. Generally, it's about 3% per month, but it's done in 3 months or 6 months increment. So if we put $10,000 in plaintiff's hands and it's in 6 months increment, the amount that is due immediately is $12,000. Okay, if the case settles in month 7 to month 12, that would be $14,000. And it is part of the contract. There are further disclosures and calculation outlining the contract. With respect to the medical side, it acts in a similar way. The numbers are a little bit different, but it's pretty much getting about 3% effective rate per month.
Breaking that down for us. Thanks for the question. Next question comes in, and if you can touch on this, what percentage of loans come in through brokers?
Approximately 15 to 20% comes in through brokers.
And I would just add to that, these aren't loans; these are non-recourse advances. So, which is why usury doesn't apply, which is why we can charge higher rates, and it's risky. If ultimately, if the case is lost, we lose, which is why our underwriting is so important, and why they do such a good job. And with our loss rate is really small.
All right, perfect. Thanks for the answer, Michael. Thanks for the clarification, Ken. And of course, thanks for the question. We do have another question just came in. What are loss rates in medical versus pre-settlement? Is it safe to assume 100% of cases are contingency cases?
So actually, the loss on the medical is less than 1% because we get additional credit enhancement for the medical provider. So for example, if a case is lost, the medical provider as a business, depending on the terms of the contract that we have with that specific medical provider, will replace that case with another case or will provide us cash. So in a way, it's less than under 1%. On the pre-settlement side is a little bit more than 2%. It's approximately 2.7%, and you don't have a recourse against the plaintiff.
Perfect. Thanks. Great information. Another question. Can you talk more about the underwriting process and inputs used?
Well, I also want to mention something. So, I mean,
Oh,
we
okay.
have access to additional information out there in the industry. So, for example, we look at some of our competitors, and our loss rate is about 3 or 4 times less than our competitors. So, we have, when we go out and securitize the assets, we go out to the credit markets, we got to see other performance, and we know that our company is significantly more conservative in their underwriting than our competitors. Sorry, well, you can go now.
Oh, okay. Actually, was that in the question that, or do you want me to repose the question? It seems like
Yeah, just repose the question, please.
Oh,
Yeah.
oh, okay,
Oh,
yeah. So
yeah, I
it was
can-
just. Oh, sorry. Do you want me to read it again?
It's can you talk more about the underwriting process and the inputs used, right?
Yep. That's the
Okay.
one.
Sure. Yeah, the underwriting process, like I said, we have a team of underwriters. We're getting the documents directly from the law firms and the attorneys. So the same documents that they have and use to evaluate the case, the strength of the case, we're getting that information. Obviously, we're not getting documents that are subject to attorney-client privilege, but basically it comes down to there's 3 major components to whether or not a case is going to settle appropriately. First is liability. What do we have that shows that the defendant is more likely than not the cause of the accident? What does the police report cite the defendant on the police report for failure to yield, driving too closely, whatever it may be? If it was a trip and fall, do we have photographs or an incident report that shows, oh yeah, there was an obvious defect here that caused this person to fall? So liability, that's the first element that we're looking at. Second element is, as we've talked about before, is insurance. Who is the insurance carrier and how much are the policy limits? Because the policy limits are ultimately always going to be the ceiling for any settlement value. They're not going to collect more than the insurance policy limits. So making sure that we have a good carrier and a good adequate policy limits is important, and that's part 2. Part 3 comes down to what this is the personal injury realm. What are the injuries? So we're getting access again from the attorney to the medical records for the treatment that the plaintiff has received to treat the injuries sustained as a result of the accident. So we're getting the initial treatment records, whether that's EMT, ER, primary healthcare physician, whatever it may be, just to show that, okay, they went to the accident happened on X date. They either immediately went to seek treatment or they went within a couple of days to seek treatment, showing the causation, between the incident and the injuries. Then we're also getting objective diagnostic tests, X-rays, MRIs, CT scans, things that can show, okay, this person has a definitive fracture in their leg. This person has a definitive tear in their rotator cuff in their shoulder. Things that, they can't fake those types of injuries. You can actually see it on the film study. And then we're also getting, ultimately, if they're getting surgery, we're getting those operative reports that show, okay, we went in, this person that showed on their MRI that they had a tear, we went in to fix that tear. We indeed identified a tear. We performed surgery and fixed that tear. So, those are the 3 things that if we are locked down on liability, insurance, and injuries, we know that that case is more likely than not going to settle favorably. Hopefully that answers the question.
Perfect. Yeah, that was a very in-depth answer. I appreciate that. Another question from Jay. Are you one of the bigger players in this space? How big is the biggest?
So we're the 3rd largest company in the space. We approximately originate $15 to $16 million a month. I believe the number 2 competitor is originating between $16 to $18 million a month, and we just right there with them. The first competitor is Oasis, and they are much larger company.
Perfect. Thank you for the question. Thank you for the answer. Another question. I believe this was a part of a two-part question a little bit earlier that might have been the second part might have been missed. Is it safe to assume 100% of cases are contingency cases?
Uh, I assume that means that the attorney is retainer agreement is on a contingency basis. Yeah, that's that's the bread and butter of personal injury cases. I don't want to say 100%. I'm sure there's situations out there where there's not, but that it's required within the language of our contract that the attorney is on a contingent basis. Again, you're dealing with personal injury clients. They don't generally have the wherewithal to pay an attorney hourly. So the bulk 99.9% of them are on those attorneys are working for that client with a contingency fee agreement that pays them anywhere between a third to 45%, depending on how far in the litigation it takes to settle the case.
This may have been touched on earlier. How do you select plaintiffs' attorneys that you will not, you will/will not work with?
Sure. As part of the due diligence process, if it's a firm that or attorney that we're not familiar with, we do background checks on them. Obviously, we look at the applicable state bar, make sure that they're actively barred. There isn't any adverse disciplinary history. They've screwed around with the client's settlement funds, did something untoward with their trust accounts. Also running clear reports on them just to make sure that they themselves haven't been in any bankruptcies, etc. And if they clear that hurdle, we'll initially tread lightly with them. We're not going to fund them their clients heavily until we get a proven track record with them. And then if it is an attorney that we have worked with, we do keep track of within our system. We do keep track of attorneys that have had a poor performance history with us. Whether it's lost cases, too many reduction requests, just difficult to work with in terms of getting status updates. Well, if that goes on, we'll blacklist them in our system and we'll no longer work with them.
Perfect. Thank you for that. Another question came in. I thought I saw initial funding is 4 to 8 months, but they settle in 24 to 30 months. Just want to verify that on the pre-settlement side, you typically see 1.3x in 14 to 15 months.
Yeah, overall the cases or the liens are settling in approximately 14 months, but with some of our pre-settlement fundings, we would advance more than one to that same plaintiff. And when the case settles, obviously all of the liens are being resolved in full.
Perfect. That was a good run on questions. It looks like we're wrapping up here soon. If anyone has any questions that weren't answered on the webinar, or you want to ask personally to Andy, Ken, or Michael, oh, never mind. I spoke too soon. I want to make sure all these questions get answered. Excuse me. How would my investment return compare to rates paid to your other debt rates?
Mike, can you speak to that?
Yeah, our warehouse lines is significantly lower. Obviously, all our committed facilities are significantly lower. So if you want to know exactly what our warehouse line, we have East West Bank is SOFR plus 3.5, Synovus is SOFR plus 390. Our rated revolving security that we have with KBRA is fixed at 7.6%, and I'm currently in the process of doing another rated security that I expect the pricing to be between 6.9 and 7.4%.
Amazing.
And Will, that's a good question by the potential investor. I should point out that our current offering was issued in August of 2023. The Fed has lowered the Fed funds rate 100 basis points since we issued that investment offering. When Mike decides that we've raised adequate capital for the foreseeable future, he will close that offering, probably initiate a subsequent offering that has a lucrative but lower yield that more accurately reflects the current rate environment. So if folks see a potential place for this in their portfolio, they may want to contact us sooner rather than later.
Perfect. Thank you. Another one comes in. How much are you raising in total?
Andy,
Mike, you want to handle that?
yeah, for this offering, we're looking at $20 to $25 million.
That they got them in right before the buzzer. If anybody has any questions, please contact Andy with the contact information. If you're watching this recording after the fact and you have questions that weren't answered, again, feel free to contact using that contact information provided by Andy throughout the presentation. If you have any questions about how this applies to your self-directed IRA, or you want to look into using your retirement funds for something like this, please give me a call with the contact information I presented at the very beginning of the presentation. Whether it's me you speak with or you just call our office, we're always happy to speak about things like this and help you with your retirement planning. And I want to take this time to thank everybody who attended, anybody watching the recording after the fact, and very much thanks to Andy, Ken, and Michael for lending their time and giving us all of this information. And yes, the slides, the recording will be mailed out. I'm sure Andy would be happy to provide the slides if requested.
Be happy to do so, of course.
Perfect. Thank you all again. Have
Thank
a
you,
great rest
folks.
of your day. Take care.